Lecture 29 Examples of Trading Breakouts. In this lecture, I will show practical examples of trading breakouts, including how you can find the best levels for profit taking and stop losses. Trading a breakout is not easy as it looks on a chart at the end of the day. In real time, after the first spike and when the breakout is being formed, there is a tremendous pressure on traders because they could not yet decide whether the breakout will succeed or it will fail, even when the breakout momentum is very strong and represented by many strong trend bars. Entering the market at the very top of the spikes looks very risky and counter logic in the same time, which might prevent vast majority of traders from trading breakouts. To trade professionally, you must understand what institutional and big traders do during breakouts. Look at this breakout example here, where the price was in an uptrend that paused for certain time, and during the pause, the price made a continuation setup that you can easily recognize from section 1 lectures, which is a bull flag. As you recall, a bull flag is a downtrend channel after an uptrend. As you see here, the channel was broken with these strong trend bull bars. Let me take this break as an example to explain how the market usually reacts to such a breakout, and more specifically, trying to figure out what is the typical reaction of institutions to this breakout. Institutional traders are either aggressive or conservative. Aggressive traders do not mind to buy at the top of this spike if they believe that the momentum is strong, but at the same time, they do not expose their trades to high risk, and they do so by trading with small positions. If the price goes up or there is a pullback reversal, then they will add to their positions. On the other hand, conservative traders hesitate to trade at the top of the spike, and they usually wait for a pullback to happen before entering the market in the direction of the breakout. So, what happened here is that the price retraced to the area near the breaking point. Then institutional traders will assess the reaction of the market to this pullback. If the pullback is deep and there was a breakout failure signal, they will exit their longs and they will enter a wait and see mood, which didn't happen here. But which approach is appropriate for retail traders? Personally, I always recommend retail traders to wait for a pullback and then for a pullback reversal signal before entering the market. Doing so, you might miss some opportunities in case that the momentum is so strong that a pullback doesn't happen. But I must say that I know some successful aggressive retail traders who prefer not to wait for the pullback, but they use proven and profitable techniques that is suitable for them over a long period of time, so they feel comfortable trading that way. One common aspect between those successful aggressive retail traders is that they use very strict risk management that compromise position size with the stop loss level. So, whatever they do, they keep the dollar value of the risk almost constant by reducing position size when they are using large stop loss. However, the conservative method explained in this lecture is more suitable to most retail traders, and this is what I recommend for you to follow during breakouts. This is an example of a successful bull breakout through a downside channel trend line. The resistance line of this channel was broken by these strong bull bars. But if you are a conservative trader like me, you will wait for another confirmation, which is typically a pullback reversal signal, which came later here. And the signal is represented by this 2-bar reversal signal that you can recall from the section 2 of this course. This signal would be a confirmation that this breakout will probably succeed, which is what happened here. Another important thing about a trading breakout is where profit targets should be in case a breakout was successful. When a breakout succeeds, it will eventually, at some point, faces strong resistance area that would make institutional traders to look for taking profit at least partially. One mistake that most retail traders make is to exit their trades very early with little profit, despite the fact that some of them were able to spot the breakout from the very beginning. To avoid this mistake, your profit-taking target must be based on some resistance level. It could be a measured move like the distance between the top and the bottom of the broken trading range. It could be also a trend line or a previous high in case of uptrends or a previous low in case of downtrends. Looking at this breakout here, where the trading range was broken to the downside here, and then a shallow pullback that has followed, could be an ideal entry point for going short with the breakout direction. But where would be your ideal profit-taking level to avoid early exit of your winning trade? And most importantly, to avoid greed that might convert your winning trade into a loser one. In this case, the best profit target would be a measured move equals to the height of the broken trading range. You can then project this measured move here below the entry point or the broken support line like this. And your first profit-taking level will be projected just here. Of course, the market can go lower than this initial take-profit level, but it is always advised that the trader need to choose a moderate level so he can at least lock some of his profits. And if you believe that the momentum is so strong, you can close half of the position and let the other half run after modifying stop loss to break even. Remember that those taking profit points are on your chart and that the big traders mark them as well. Try always to make your winning trade as profitable as possible. This is not easy psychologically, but with practice, you will learn how to spot areas where big traders might take profits, and you can take your profit at the same price. Here is another example of downtrend that is followed by a trading range. And because the previous trend was a bear trend, traders must bear in mind that a bear breakout is more likely to succeed than a bull breakout. When other strength signs given previously taken into account, this breakout by these strong bear bars is considered a good shorting opportunity to ride the next leg down. With this lecture, you come to the end of this section, and in the next section, we will analyze together live trading setups, which will enable you to apply the techniques that you have learned in this course to real-time price actions.